Good afternoon, everyone. Welcome. This is Live with MainStreet, and you've got Anna and Jim, and we are excited to be here. Hi, Jim.
Hi, Anna. Where are you today?
Haha, I am in my office. How about you?
Oh, I just thought I'd go to St. Louis to see a couple of clients, so that's where I'm at today.
Oh, that's wonderful. You get to go everywhere, Jim. Aren't you tired yet?
Oh, but most times I'm getting up at 4 o'clock in the morning. Tomorrow will be 3:30, so
Oh,
hopefully our audience will have a little sympathy for me. A little, anyway.
a little bit. All right. Well, why not? You need to be challenged. 4 o'clock is not early enough.
Okay, so listen, the theme for this month is end of year questions because although our restart for 2018 is almost underway, uh, the questions we got, and we got quite a few, are really
Yes.
about current events. So maybe you can start with those, Anna.
Yes, and a lot of them have to do around the tax bill that we are waiting to get passed. And so, is there anything we need to do right now, Jim, or how would our taxes for 2017 be affected? So, what thoughts do we have here?
Well, Anna, think of this process as four steps. You have the House, you have the Senate, you have the conference committee, and you have the president who either signs or vetoes it. So those are the four steps. We're between step two and step three right now on December the 2nd. And so the question we got about how will this tax reform bill affect my 2017 taxes, everything that you and I have seen, it indicates that nothing is retroactive. However, remember, there's a conference committee and a president coming up for steps 3 and 4. So the only thing that I have seen where people might want to pay extra special attention would be to move forward contributions into this year in case the charitable deduction is reduced. I don't know if that's going to happen or not. I know the nonprofits are lobbying hard. So it would just be to pay attention to charitable contributions, but you'd have to see what the bill that is signed into law says.
The other thing I think I read was property taxes. So there was some kind of a conversation about property taxes being kept at 10,000 deduction for that. So for our clients who are in metropolitan areas such as San Francisco, New York, DC, I guess no, DC probably won't have, actually maybe certain areas. So that might be something to think about, but can you prepay property taxes this year? So that's what caught my eye in terms of those things. But I think what we're advising is to hold on and doing anything and even panicking about it because we are in step two, as you said. So we still have to go through two steps and things may change quite a bit, right?
Yes, and so I would caution our viewers to pay attention to publications like Kiplinger, Money Magazine, the New York Times, the Wall Street Journal. All will have what to do articles on it, and they will be fairly well vetted. And you can probably read 2 out of the 4 publications that I just mentioned and get a good idea of what you should do before the end of the year.
Yeah, and we may have a special either articles or a special episode if things do come up.
Really? I'm going to be on vacation. I think it's going to be you only, Anna. Sorry.
Oh, I can do it myself. No problem.
Okay.
They're going to miss you, Jim. Okay. All right. So on to the next question. I think we got the tax one out of the way, right? I think we've covered what we wanted to say. So
yes.
Wait and see. Okay.
Okay.
All right. So our next question has to do about protecting children and children's inheritance from their failed marriages and relationships. So the parents are worried if kids' marriages aren't stable enough or aren't going to survive, and they may have an inheritance coming their way. What do we have in terms of recommendations?
Well, first of all, thinking of the chronology, if it's a married couple that's thinking about this for their adult children, think about the ages that they're liable to inherit the money And that's usually in their 50s or 60s because the parents are dying in their 80s and 90s. So, first of all, it may be very premature to worry about these things now. But what we've seen in the past is the estate planning attorneys have created trust, either ongoing trust or testamentary trust, which means they pop up at a certain death, that would capture the money and keep it in a separate entity. And inherited assets usually move to people individually, not as a couple. And if you keep those assets segregated, it's not subject to community property or other division. However, that's the area of legal advice, and attorneys are the best people to come up with the strategies for couples. Like this couple comes from California, where it's a community property state. And my experience in the past has been testamentary trust or inter vivo trust, which means they're ongoing, created by the parents now, that keeps the assets being bequested in a trust. So that seems to be the most favorite vehicle in my experience.
Yes, and I think I would also want to add, we need to make sure those parents who are concerned about this is to get their estate planning documents in place. Because if you don't have anything in place, guess who's going to decide how all of this works?
A judge.
Yeah, the state you live in, and if you live in California,
the probate court.
That's right. If you live in California, it's fun to live here, but it has the worst probate in a country. So welcome. You pay the sunshine tax, and you get to deal with probate. But yes,
okay.
I think we've contributed enough to this question, and would defer to estate planners to give more detailed and specific advice. Okay, sounds good. All right.
So I'm going to toss one up to you, Anna.
Yes.
Given the relatively long bull market run, and more importantly, somehow our questioner says that the stocks are fairly valued at the moment, are there any recommendations for portfolio rebalancing?
Well, there are always recommendations for portfolio rebalancing. I think I would want to start with is to see where your portfolio is in terms of its target allocation. So that's the first way to look at it. Now, sure, maybe the stocks are at higher valuations, but since we're not actively managing anybody's accounts, right? I would stick around focusing on what the target allocation is, and if and how the overall goals have changed. Because if they did, then maybe we need to change or recommend changing an allocation for percentage of stocks or bonds. So that would be my approach. I wouldn't have anything else to add.
Well, I would, in the timeline to starting to use the assets, and that usually for most of our clients is how close are they to retirement, or how close are they to a major event like a wedding or something where they might need some money. And therefore, that usually changes over time. And so that's one of the key questions we're always asking people is, what's your need for cash in the next couple of years? And how soon till you're going to stop putting money away and dollar cost averaging? And you just have to ride the roller coaster without digging your way out of any hole that happens.
So are you referring to having more liquid positions on hand? So we're talking about having an extra cushion for withdrawals, because we're anticipating that.
Well, let's go to the next question, and we're going to resolve that.
There we go. Okay.
Given the current state of the stock market, what are your recommendations for cash holdings? Stay in cash for a while, invest, and invest in what?
Yes. So we like the idea. We always teach all of our clients the buckets theory, right? So this is how we approach portfolio recommendations in terms of what our long-term goals are, what our short-term goals are, and what our mid-term goals are. And that way we can help you align your portfolio according to those goals. And so if we're talking about buckets, we have 3 buckets that we like to have. There's just a theory, or a concept. And so you have bucket 1, which would be for our sort of immediate needs, right? That could be emergency fund and those cash withdrawals, right? So if you are getting closer to retirement, or you are in retirement and you're drawing from your portfolio, then your bucket 1 needs to have enough funds in there to support you for the 3 years. So that way buckets 2 and 3 can stay in the market and be invested appropriately, so you're not worried perhaps that you need to be changing your allocation because of market fluctuations. And so in terms of the cash holdings, I would focus for our pre-retirees and retirees for 3 years worth of withdrawals. Now, for our clients who are still in the accumulation phase, I think we need to focus on emergency fund, right? Having enough liquid monies there, and that's usually 3 to 6 months worth of living expenses. And also think about what kind of goals you have coming up that may need capital. So in the next 3 years, if there's something on your horizon that you want to accomplish that needs funding, that kind of capital needs to go into the bucket 1, or maybe a savings account, something that's not affected by the fluctuations of the stock market. Now, what else we want to add, Jim? What was the question? Stay in cash for a while, invest.
How would you invest it?
Well, if we're talking about bucket 1, our next 3 years, it's pretty simple. CDs, online savings accounts. So pretty boring kind of investments, right? But they're safe and they're guaranteed to be there. Obviously for our buckets 2 and 3, that will all depend on your time horizon, right? And the need for your portfolio and when you're going to draw from it.
And it's not untypical these days that the retirement accounts where our clientele have to take out the required minimum distributions, that we maybe have 1 year's worth of cash for 2018, and then maybe a 1-year CD and a 2-year CD to get a little more return on their bucket 1 money, but yet have it available at 100 cents on the dollar.
Yes, true. We can put it in bucket 2 and get a little bit more return, be more creative, right? As you say, we can get 1.3% or 3.5, I think, for savings accounts. Mm-hmm. Okay. Well, great. Now we have another question that's a little bit different, but has to do with Social Security. I think this is your area of expertise, Jim. So yes. The question is, when should I start taking Social Security? As soon as I'm eligible, or should I wait? And are there any mitigating factors? I think it's a very general question, but let's talk about when should you take the benefits? Well,
there's 3 issues, in my opinion, that people need to deal with when they're thinking about Social Security benefits. The first one is, do they need that money? So need, yes or no, or could I take it from other savings? And if you don't have any other savings, obviously the need is the paramount factor. Life expectancy is the second issue to deal with. If everybody in your family, aunts, uncles, parents lived into their mid-90s, then that money needs to last a long time on Social Security. And your tolerance for risk is the third issue, meaning maybe you delay Social Security because it's an automatic 8% increase every year from the time you're first eligible until you reach age 70. So you use up your other assets first of all because they have volatility, and you delay Social Security because it is a fixed income stream. It is a lot safer money. Although the Congress has started making noises about changing Social Security, I'm still of the opinion that they're going to stay away from that just because there's too many voters that are counting on Social Security at the current levels. So the main mitigating factor is your need, how long you're going to live, and do you want to spend some of those volatile assets first and keep the long-term income streams that increase in value till later. How's that for a succinct answer?
That's pretty good. But have you noticed, Jim, and our clients are probably seeing this too, when they pull up their Social Security statement, right on the page where it lists what your benefit will be at a different age, it tells you in small print that by 2034, they're only going to have 79% of benefits. So how does that factor into all of this? Clients deciding, do I take this now, or I want to have 100%, or I want to wait and have more higher benefit, but only 79%.
Well, it's up to our elected officials to change a number of factors in the Social Security benefit system to make it whole again. Changing the normal retirement age from age 67 to 70 puts things on the same track for the rest of the century. They're not going to run out of money. If they tax higher than $130-some thousand every year, that helps make it solvent. Reducing or increasing the amount that is taxed from 0%, 50%, or 85% to 100%, that makes things sound. There's a number of things our elected officials can do that they have failed to do in the past to put Social Security back on a sound basis. I'm betting that within a few years, there'll be the crisis sound, and they'll put it on a more fiscally responsible basis. So that's where I'm asking people to place their bets that the Congress will get their act together and support Social Security at 100% funding level.
Yes, we shall wait and see. But we are planning more conservatively for our clients, especially younger ones, that they'll all come cynical and say, "Oh, forget Social Security. What's Social Security? It will not be there for me." So we do have that as one of the assumptions, right, that we use in our plan. Well, very well, Jim. I think we're about right out of time, and we've covered all of our questions. So we'll be back next month. Who knows where we're going to be physically? At least we'll be all together online. So everyone, thanks for watching. Send us more questions, and happy holidays for the rest of the month, because we're about to, yes, December 2nd. So we're about to finish this month pretty quick.
Right. Merry Christmas, Happy Hanukkah, and all the rest of the festivities that are coming up in the next 6 weeks or so. Okay?
Yes. Happy New Year as well. Okay. Bye, everyone.
Bye, everybody.